have opened a window of opportunity for the bears, who now appear to be behind the driving wheel. In this report, we are to take a different approach than usual and focus mostly on major fundamental issues that surround the US stock markets. The well-known credit rating agency Moody on Tuesday announced that 10 regional leaders would have their credit rating downgraded by one notch, while 6 well-known banking giants, of which some had aided First Republic Bank during their troubles, are now at the risk of being downgraded as well. Those lenders are Bank of New York Mellon, US Bancorp, State Street, and Truist Financial, all of whom aided First Republic Bank alongside JP Morgan, Bank of America, and others created a $30 billion rescue package to rescue First Republic. Given the surprise downgrade, market traders appear to have been put on edge, as the Dow Jones 30, Nasdaq 100, and S&P 500 all recorded declines following Moody's announcement. In the event that more regional banks are downgraded, we may see further fears from investors who may be worried about a repeat of the Silicon Valley Bank crash back in March. Therefore, in the event of further banking fears emerging regarding the strength of their balance sheets, we may see that fear translated in the US equities markets, with the market potentially reacting unfavorably and pushing the equities market lower. Last Friday, the US employment data was released, providing a mixed picture for market analysts. On the one hand, the non-farm payrolls figure for July came in lower than expected, potentially indicating for the less resilient labor market on a month-to-month basis, with the actual figure coming in at 187K compared to the expected figure of 200K. Furthermore, the unemployment rate for July ticked downwards, with the actual rate coming at 3.5% compared to the previous month's rate of 3.6%. Therefore, the mixed employment data appears to have created some uncertainty in the markets, where on the hand, the data will indicate that the high interest rates and inflationary pressures appear to be making their way into the labor market. Yet, on the other hand, the unemployment rate declining brings the US closer and closer to full employment, which widely considered to be at the 2% unemployment rate level. As such, market participants may be turning their attention to the US CPI rates for July, which are due to be released tomorrow, in an attempt to clarify the current economic situation in the US following the mixed employment data. In the event that the CPI rates accelerate, we may see the US equities markets moving in a downwards fashion, as it could be interpreted that the Fed may have to continue their aggressive interest rate war path due to persisting inflationary pressures, thus strengthening the greenback, which in turn could weaken the US equities markets due to the increased cost of acquisition of US stocks by foreign investors due to a stronger dollar. On the other hand, should the US CPI rates come in lower than expected, we may see US equities market moving higher, as the potential of the Fed easing on its aggressive rate hiking path could potentially weaken the greenback. Therefore, US equities could be more accessible and cheaper for foreign investors buying stocks denominated in the greenback. In addition, stock traders may still have to navigate through earnings reports, which are being released. We make a start with Amazon, which beat its expected earnings per share by $0.31, and its revenue came in higher than expected at $134.65 billion, beating expectations by $3.04 billion. Furthermore, we note Apple's mixed earnings report, where its earnings per share beat expectations by coming in at $1.26, yet the revenue came in lower than expected at $81.80 billion. Up until our next equities report, we note the possible release of Super League Gaming, Home Depot, JD, Cisco Systems, and lastly, Walmart. Thank you for watching.